September 15, 2008. Lehman Brothers collapses. 158 years of history gone in a weekend. Markets plunge, credit freezes, panic spreads like wildfire across Wall Street. Within days, the entire global financial system is teetering on the edge. We're looking at another Great Depression. That's what they told us. So governments did what economists said they had to do. They bailout out the banks. $700 billion in America alone. Trillions worldwide. They called it saving the economy, but here's the part nobody talks about. The people who caused the crash got bonuses. The families who lost their homes got nothing. And the economists who designed the whole mess, they got promotions. Because buried underneath all the chaos was a lie so big, so foundational that questioning it makes you sound crazy. The lie is this: banks take your deposits and lend them out to borrowers. Your money sits in a vault somewhere. When you swipe your card, the bank is moving your actual dollars around, except none of that is true, not even close. Let me show you what really happens. You walk into a bank and deposit $1,000. You check your account, it says $1,000, great. Now your neighbor walks in and takes out a $900 loan. You check your account again, still says $1,000. Your neighbor checks his account. It says $900, so how much money exists now? If you said $1,900, congratulations. You just discovered fractional reserve banking. The bank didn't lend out your money. They created new money out of thin air the moment they approved the loan. That $900 didn't exist 10 minutes ago. Now it does. And it's backed by nothing except your neighbor's promise to pay it back. This isn't a glitch. This is the system. In fact, 97% of all money in circulation was created exactly this way. Not by governments, not by central banks, by regular commercial banks typing numbers into computers. But wait, there's a limit, right? Banks can't just create infinite money, correct? They're supposed to keep a fraction in reserve. That's the fractional part. In the US, that fraction used to be 10%. So for every $100 you deposit, they could create $90 in new loans. But in March 2020, the Federal Reserve dropped the reserve requirement to zero. That's not a typo, zero, meaning there is now no legal limit to how much money a bank can create. None. Let that sink in. The system we trust to store our wealth, fund our businesses, and stabilize our economy runs on a mechanism that would get you arrested if you tried it in your garage. Imagine you started a business. You tell customers, give me your money, I'll keep it safe. Then you take that same money, lend it to someone else, but still promise the first guy he can withdraw at any time. That's called fraud. Unless you're a bank, then it's called banking. And when it goes wrong, which it does constantly, we're told the only solution is to let the government step in and create even more money to fix the mess caused by creating too much money in the first place. You can't make this up, so let's go back, way back, to when this all started. 1694, England. King William is fighting a war. Surprise, he's out of money. Also not a surprise. He needs to borrow, but nobody trusts him to pay it back. So a group of wealthy merchants make him an offer. We'll lend you £1.2 million. In exchange, you give us a charter to operate a bank. We'll call it the Bank of England, and here's the fun part. You let us issue paper notes backed by the gold we're lending you. Then we'll lend those notes out too. The king agrees. And just like that, money stops being a thing and becomes an idea, a promise, an IOU backed by another IOU. For a while it worked because the system had limits. Paper money was backed by gold. You could walk into a bank and demand the actual metal. That kept everyone honest. You couldn't print more notes than you had gold to cover. But then World War I happened. Governments needed to spend more than they had. So they did what governments always do when reality gets inconvenient. They changed the rules. One by one, they suspended the gold standard. Printed money to pay for tanks, ships, trenches, and millions of soldiers. When the war ended, they didn't go back. They kept printing. Germany printed so much that by 1923, inflation hit 29,500% in a single month. People were paid twice a day because money lost value by the hour. A woman used stacks of cash as wallpaper. It was cheaper than buying actual wallpaper. But even after that disaster, the lesson didn't stick. By 1944, the world tried again. Bretton Woods, every currency pegged to the dollar pegged to gold. $35 per ounce, fixed. For 27 years it held. Then came Vietnam. Then came the Great Society. Lyndon Johnson wanted both, war abroad, welfare at home. His advisors asked, "Can we afford this?" He said, "Why choose?" So America printed dollars, lots of them, but the gold in Fort Knox stayed the same. Other countries noticed. Francis Charles de Gaulle sent ships to America in 1965 and said, "We would like our gold, please." Other countries followed. By 1971, the U.S. had $14 billion in foreign claims and only $3.2 billion in gold. The math didn't work. So Nixon did the only thing he could. He lied. August 15, 1971. Nixon interrupted primetime TV and announced the U.S. would no longer convert dollars to gold. He called it temporary. It wasn't. From that moment on, every dollar, every euro, every yen was backed by nothing. Just a government's promise not to print too much. Guess how that went? Since 1971, the dollar has lost over 85% of its purchasing power. A house that cost $25,000 in 1971 costs $400,000 today. It's the same house, same wood, same bricks. The dollars just became worth less. But here's where the lie gets really insidious. When people notice prices going up, they blame businesses, greedy corporations, price gouging. Inflation becomes a moral problem, not a monetary one. Nobody blames the printing press. And the people running the printing press are happy to keep it that way. Because if you understood that inflation is just theft by another name, you'd be furious. Let me show you how it works. Imagine there are 10 apples in the world and $10 in circulation. Each apple costs $1. Simple. Now the government prints another $10. There are still only 10 apples, so now each apple costs $2. Your $10 is now worth 5 apples instead of 10. You didn't get poorer because apples got more expensive. You got poorer because someone printed money and diluted the value of yours. That's inflation, not rising prices. Rising money supply. Prices are just the symptom. But if people figured that out, they'd start asking uncomfortable questions. Like, who benefits from printing money? The answer is simple: whoever gets the new money first. When the Federal Reserve creates money, it doesn't drop it from helicopters. It goes to banks, to governments, to Wall Street. They get to spend it before prices rise. By the time it reaches you, the prices have already gone up. It's a transfer of wealth from the poor to the rich, hidden in plain sight, and it's completely legal. In fact, it's policy. After 2008, central banks printed over $25 trillion. They called it quantitative easing. Sounds boring, sounds technical. It was theft. Stock markets soared, real estate exploded. The wealthy got wealthier, and everyone else got told to tighten their belts. Then came 2020, pandemic hits. Governments shut down economies. Millions lose their jobs. So what's the solution? Print more money. $5 trillion in the U.S. alone. Checks went out, rent got paused, and for a moment people thought, maybe this works, maybe we can just print money when we need it. Then inflation hit 9%. Suddenly groceries cost 30% more, gas doubled, rent skyrocketed, and once again we were told it was corporate greed, supply chain issues, Putin's fault. Anything but the obvious. You can't print prosperity. You can only print inflation. Here's the truth they don't want you to know. Money is not wealth. Claim on wealth. Printing more money doesn't create more wealth, it just dilutes the claims. Real wealth is houses, food, cars, infrastructure, skills, time, things that actually exist. Money is just the tool we use to trade those things. When you print more money without creating more things, all you do is make the tool less useful. It's like adding water to soup. You don't get more soup, you get more water. But the lie persists because it's convenient. Politicians get to spend without taxing. Banks get to lend without saving. And economists get to pretend they're solving problems while actually making them worse. Meanwhile, the average person works harder, saves less, and wonders why they can't get ahead. They're told it's their fault. They didn't go to college. They didn't invest. They bought too much avocado toast. But the real reason is simpler. The money they earn today is worth less than the money their parents earned. And it's worth less because someone, somewhere, is printing more of it. That's the biggest lie in economics. And you still believe it, because they never taught you how money actually works. They just taught you how to use it, and as long as you keep using it, they'll keep printing it. Until one day, you'll need a wheelbarrow full of cash just to buy groceries. And by then, it'll be too late.